Future of this business is going closer between the borrower and the money, and everything that widens that out is not the future. So layers, company, it doesn't matter, broker, IMB, direct to consumer, as long as this is happening, the borrower is getting closer to the money, that's where it's going. Shift happens, opportunities change, and success is a choice. So when shift happens, it is our choice. Either we let shift happen or we can make shift happen. Yo. Hey, we're going a little talking shift live with my good buddy, Gino Fronti here. And you know, it was cool because we were just having a huddle together and we started talking about where we think the future of this business is going. And we like, holy shit, we need to record this because everyone needs to hear this. So real quickly, everyone, Gino, hey, welcome to Talking Shift Live.
Yeah, thanks, man. Yeah, we were just really just hashing it out and talking about what we're seeing in the marketplace, what the future of mortgage looks like, what the next 12 months look like, not only what 5 years from now looks like, but what the next 12 months look like. And so from my seat, the things that I'm seeing, from your seat, the things that you're seeing, from the conversations that we're having with the top of the house, with all the different companies and all the different vendors. And we said, you deserve to know. Like, you really need to know what's happening as an originator, as a branch manager, as a leader in the space. You need to know what's happening so that you can shift, so that you can adapt, so that you can be nimble. I truly believe that these next 2 years is about being nimble. It is about being prepared for change. And a lot of the things that we're talking about when I talk to leadership at other companies is change management is actually a thing. Getting humans to break their habits and adopt new habits is something that we're all challenged with today. And, so the question is, how do we solve it?
Yeah.
And what are the headwinds? What are the tailwinds? What does it look like? And Craig brings up this one point,
Yeah.
and I'll let you speak to that, Craig, and then I'll go on with the second point that I was making.
Yeah. And, you know, we're like, this is not even a new conversation, but it's happening at velocity now. Like now it's now starting to happen. And I think this is the fundamental that really kind of dawned on me. The bottom line is borrower, money. The future of this business is going closer between the borrower and the money, and everything that widens that out is not the future. So layer, company, it doesn't matter, broker, IMB, direct to consumer, as long as this is happening, the borrower is getting closer to the money, that's where it's going.
Yeah. Yeah. And
And
I mean, if you look at other industries that's already happened, I always like to use the travel industry as a perfect example of that, right? You went from travel agent. So there was that person in the middle that helped you acquire the best travel. And there's still a place for that. For the uber wealthy, still use travel agents. But for the average consumer, they go on one of these websites, whether they're going direct or going through a middleman, using technology to find the best deal, or using an LLM to find the best deal. You described exactly that. They got closer to the source in order to eliminate the override. And so what you're really seeing is, with inflationary pressure on the consumer, they're looking to find a way to save money. That's really what it is. And I know that we look at them and we say, they're shoppers. Oh, they're not loyal. Oh, yeah. Listen, that's not it. They can't survive if they don't find a way to do this. And they have the tools at their disposal to do it today. And so what we need to solve for is, how do we get them closer to the money, still make a fair business revenue for the company and for the individuals that are providing the service for the consumer? It's a high education business. And I described it the other day on one of my posts. I said, everybody in real estate always had that one wise uncle that bought a house 20 years ago or went to college 30 years ago or whatever it was. And they would ask them for real estate advice. And then they would rely on their realtor and their loan officer and their CPA to kind of fill that gap. Well, today they have 30 uncles, and their names are ChatGPT, Claude, Perplexity, you name it, any LLM you like to use, Copilot, whatever you like, gives you lots of opinions. And we all know that they're not always right. And so what I like to say is, go ahead and get those opinions. Educate yourself, but what you should ask your LLM about real estate is, what questions should I be asking my advisor? And still use a human as your advisor to help you navigate what questions you should be asking. Don't ask it for the answer, because the answer might be wrong, because it doesn't understand your perfect scenario and what's going on in your life and what your tax returns look like and what your financial picture looks like. but ask it to ask the right questions so that you can go into it educated and you make sure that you come out with the questions that you need answered so that you feel empowered to take action.
Yeah, and you bring up the right point, because then, I mean, let's just get down, and I'll be the guy here. Like, what's the future of the loan officer? And my opinion is the loan officer is not going away. Let's just get that out of the way right now. Loan officer is not going away. However, I believe that AI is going to replace the manufacturing line. That's just what's happening. It's happening fast, and nothing we're talking about is 100%. So we don't have to argue all or nothing, but it's replacing manufacturing. That means the originator can't be in the manufacturing process. What
Thank
it also
God.
well, right. Like,
They
it's
should
not.
never have been. I've always been arguing this. The person that engineered and made this water bottle is not the person who's selling it. Why did we insist in the mortgage industry that the person who's selling the product also needed to manufacture the product? It was dumb from the first place. We just didn't have a way to solve it.
Yeah, now we have a way to solve it, and that's happening. But here's the thing: that's not even going to be innovation. That's going to be table stakes. So again, as we're closing the gap between borrower and the source of money, as that gets closed, that's what AI is facilitating. So I think the future loan officer are, again, this is not new, but our humanity, our humility, our curiosity, everything you're talking about, that advisement, we're going to lean into our consumers going to their smart uncle or the large language models, the AI, but we got to help train them on what to ask. And then we are the human advisor. And I think the future is going to be originators are going to have to do 10 times the volume and probably make 10 times less commission. And I'm sorry,
Per
but that
loan.
is reality.
Per loan.
Per loan. We're going to do, so we're going to make more money by doing more production. But look, we've been talking about comp compression. Again, not a new conversation, but that's coming. It's coming fast. And part of the reason why is because your competition is going to do it. Direct to consumer, like we were just talking about, that thing is on the rise. The servicers, in every different. So it doesn't matter. I don't care IMB or broker or whatever. It's just when this starts collapsing, that competition is going to facilitate these bigger changes. So it's just getting in front of that is all.
Yeah, so let me break that down for you the way I think this plays out. I think agency lending is where you're going to see comp compression the most. And then I believe that additional higher comp will be in the specialty fields. And so if you think about it, this is nothing new. If you look at it globally, if you look at other industries, if you look at, for example, medicine, okay, what happens? You go to your primary physician and that primary physician says, hey, I see that there's a problem over here, but I'm not a specialist in that. So I'm going to refer you to a specialist in a division where that's all they do. And those guys are really good at what they do. But this person at the front, this primary physician, is still kind of the quarterback of the whole thing, but it's got all these other players on the field that are specialists in those things. And so that's one of the things that we're building at Lower, so that when an originator comes into our organization, they can do everything, but not by themselves. They have a team of specialists and specialty divisions that help them do that. And those are the things that we've all done that over the years a little bit, right? You had a reverse division, maybe you had a renovation division, but what's happening today is that's happening at scale. And now here's the big one. You have a refi division. Okay. Let's just talk about it, get it out in the open. Loan Depot's doing it. We offer it. It's an opt-in program only. But if you're a purchase originator, and that's what you do, and you build relationships and you spend time with your realtors and you really believe in the dream of home ownership, then, and you have this, let's just call it 100 basis point product that you sell. And then there's this other product over here called refinances. That's been what's been commoditized. That's where the servicer plays. That's where everybody's fighting with where the comp compression is highest. And let's just say that's 50% off and you only can get 50 basis points in that model. Then why would you, as a high valued advisor, spend your time selling a low margin product when you could sell a high margin product? And so what I think happens here is you sell a high margin product because it's the one that takes the most time and effort. And that's why it deserves the most margin. And it's the one that carries the most risk. You miss your moving date. You can't start your job on time. Kids miss their school starting date. You're living out of a moving truck. Like, it's the highest risk transaction. It should have a premium tied to it. And then for the loan officer that's that advisor, you have a residual trailing income like you do in insurance for renewals. And that's what a refinance is. It's a renewal. So now you've got point of sale like you do in insurance with renewals and trailing annuity income that's being taken care of by the refinance specialist on your team. So you're not wasting time on it. I don't think that's wrong. I don't think there's anything wrong with it. I think we should embrace it and just know that that's the model. And I can't tell you how many of my top producing purchase loan officers will say, I hate refis. So if
Sure.
you hate them, why do you want to do them?
Well, I mean, just by the sheer definition of being an originator, your job is to go out and originate. That's it. That's all.
Yeah.
And go do the things that you love, the relationship building, the generating, the partnering to help bring up, to help spur more business and going outside, the scope of maybe your one landed business. I mean, you said it earlier, it's all comes down to scale, and that's the magic word of how do we accomplish economies of scale, whether in your own practice, your production, your manufacturing, how you produce loans, all these different things. Again, scale is going to happen when the consumer and the dollar get closer together, and then we can leverage and aggregate, that business. And so,
Yeah, and when you had done this design in our earlier call, and why I said we should jump on this is there's a thing called the barbell theory. It's an economic theory of the barbell theory. And when you put your fingers up like this and you showed that, yes, the barbell is getting smaller. And the reason for that is small companies are very nimble and can change very quickly, and they can specialize in something, and so they'll survive. And then big companies have economies of scale, the ability to invest in technology, the ability to write signing bonuses, to hire the best talent, to do all those things. So who's in trouble is the people in the middle of the barbell. And that barbell was very long for a long time. And
yeah.
so
And it was
now we're
forgiving.
seeing that it was great, but now we're seeing the barbell shrink. And as we're seeing the barbell shrink, what does that mean? That means mergers, acquisitions, consolidations. These people in the middle are saying, I don't want to play this game. And now add one more thing to this barbell here in the middle is age demographics of your loan officer and age demographics of your owner. And so when you look at owners that have already made their millions and they've done a wonderful job over the last 20, 25 years, and they've weathered the storm that we just went through, and they've proven that they built a good company, when they look into the future and they say, oh my God, what do you mean I have to invest 15 to $20 million in technology to maybe compete against the big guys? And I say maybe because the big guys are spending 50 or 100. And so I don't think they're willing to take that risk. B, have the desire to re-inject capital into their business as they should. And C, they may just not have the energy to do it again. They've already done it and they don't know if they have one more in them. So it makes sense that they say, look, I built a great company. We've weathered the storm. We've done good things, but I should partner with a bigger company that has all the resources to play in this next round, so that my loan originators have a great home, because I do believe that those people that built those companies in the middle of the barbell built great companies. That's just not for where we're going next.
So let me ask you a question. So you're an originator, you're listening to this, and however that's landing, let's say I'm an originator, I'm listening to this, I'm going, shit. Because the first sign of somebody kind of being defensive or really knocking someone down is because they know it to be true. So let's say someone's listening to that going like, yeah, so now what do I do?
First thing you got to do is look in the mirror and say, how nimble am I? Where am I in the barbell? Me, not the company. Where am I? Am I excited about the future? Am I willing to work hard? Am I willing to do new things and learn new things and learn new product? Again, am I a specialist or am I a generalist? Am I an agency lender or am I a specialist? Am I going for volume and scale, or do I want highest comp per loan? Highest comp per loan will exist in the specialty space. Highest comp per loan may exist in the broker space. If you only want to do 2 loans a month and that's enough for you and your family to live off of, maybe the broker space, the little company that's over here that's going to survive you, that maybe that's the right place for you. But if you're trying to build a business, if you're trying to have scale, if you're trying to do 5 loans a month or more, say, I definitely don't want to be in the middle of the barbell. I don't want to be at one of these companies. I want to either shift to specialty at a big company, or I want to stay as broker and just do a couple loans per month in my semi-retirement. That's cool too. But just don't get stuck in the middle. That's where people will go to die. So first look in the mirror and say, who am I? What do I want to do? And if you're aggressive and you're hungry, then move this way. Move towards the bigger companies. Move towards the companies that are leaning in hard right now. Not say they're leaning in, but actually look at what they're doing. And then when you evaluate companies, I think this was a really good thing that came out of a call that I was on earlier this morning. When you're evaluating a company, and I look, I'm guilty of this too. Like I've been doing this for 25 years and I'm guilty of when I'm shopping for a company, I'm comparing everybody about where they are.
Mm.
Where are they today? What's my tech stack? What's my pricing? What's my this? What's my that? I think that's a mistake. And I think the question you have to ask yourself is where are they going and
Yeah.
how fast are they going to get there?
Where are they investing?
Yep. And then you can look at the behemoths and say, because they're big today, this could be a David versus Goliath story. And those big ships are hard to turn. So being at a company that's at the barbell but moving here could be the right play for someone who's hungry and wants opportunity and wants to do these things and is looking for the next 10 years in their career. If you've got 2 years left in you, maybe your decision making is different. But if you've got 5, 10 years left, then you've got to start thinking about where is the place that's going to support my desire to do X and is in alignment with my desire to do X with their desire to do Y. And when X and Y come together, that's when you have a winning story for you. And, I think you've got to figure out more about alignment. And I think alignment is probably one of the most important words that you can use when you're shopping for a new company or when you're identifying whether the company you're with is good for you or not. Am I in alignment? Are our goals in our alignment? Is our vision in alignment? Do they respect who I am and what I'm trying to achieve? Am I feeling empowered and valued? Or am I just a cog in the wheel, just a number? And so, can I achieve what I want to achieve in life? And am I partnered with the right humans that have the right desire that is in alignment with what I'm trying to do? Those are the questions you got to ask yourself. And then again, if you're in the middle, personally, evaluate yourself. And then now that you know who you are and what you want to do, ask yourself if you're in alignment. And if you're not, move to one side of the barbell.
Okay, so that's something I love. Like I love what you just said. Let me energize that a little bit. I think alignment and barbell, 2 words. Like if I want you to remember
We have a new glossary of terms.
Yeah, exactly. It was vigorating. Now it's like there's just 2 things: alignment and barbell. And in this instance, if I'm an originator, the barbell for you is: do you want to grow and aggregate more business, or be a specialist and be able to make more margin on less business? But being in the middle and being that generous, I do it all. I still want to make all my comp I think that again, that's where you're going to get squeezed out. So you either have to, I want to aggregate, and the people who are crushing it right now are on both sides of that barbell. They're not in the middle. The people that are, I am an originator, but I'm the CEO of my business. I mean, that's what I coach towards, is to help you be the CEO of your business. I don't mean you have to be the CEO of the company, but you have to look at your business as if you're a CEO. So we're going to aggregate wide volume, large volume, where we're building business in multiple referral revenue, self-generating revenue. We're looking at this thing, and the manufacturing, we are letting go of manufacturing. We have a team, we have technology, we have those things, so we can scale as much production value. I'm the production value that brings in the production. So there's barbell 1, or to your point, barbell, the other side of the barbell is I'm going to be a specialist, whether it be up reverse or non-QM or whatever that case is. High value, high touch, higher margin, But like you said, I mean, that fast pitch down the middle, Fannie, Freddie, Govy, that stuff, that's where these 2 things, borrower, source of money, is going to continue shrinking. And that's where these disruptors in Silicon Valley are coming in. That's where servicers, direct to consumer, and so again, I think that concept of alignment and barbell, applies whether personally or at scale, with the company. And I think it's a good thing to just sort of keep in light.
Yeah, so it's funny. Before we got on this call, I'll just be transparent with you guys. I asked Craig a couple things, and he says, "Well, what if we say something controversial?" And then he says, "Well, what if you say something controversial?" And I said, "I certainly will. I certainly will." So let me talk about something controversial. Yesterday, there was this big news story about how Better.com closed the first crypto-backed loan with Fannie Mae, and the consumer didn't have to liquidate their crypto assets.
Ooh, I didn't read that.
Okay, so, but some people did. And if you read the headline said, "Better Fannie Crypto." If you dig deeper, This is what it really said. What it really said is that this is the first pledged asset loan that the government's ever done.
Mm.
Okay. And we've been doing pledged asset loans for the wealthy for a very long time. So this is not a new concept. But what does that mean for housing? And crypto is just the tip of the spear here, because what's going to happen is they're now saying maybe we'll let people keep their assets instead of putting it as a down payment on their house.
Mm.
Let their assets grow here and let them acquire housing, and that grows here. We're increasing the net worth of the average consumer by about allowing two asset classes to grow at the same time. And what that means is that what they've done is they've unlocked the housing market in a way that's never been unlocked before, where now you're not giving up your capital to put it in a new asset. You're actually keeping your capital and still acquiring a new asset with maximum leverage. So you're effectively financing 100% of the home, and you're doing 100% you're doing 100% Fannie and Freddie loan. And what I see that happening is when you're looking at the housing costs, this is going to drive property values up into the future. We're allowing people to buy at 100%. That's what just effectively happened yesterday. And it was nowhere in the story. And it was funny because yesterday I said to myself, I said, God, I got to get on LinkedIn and tell this story, because people didn't see that in the storyline. And now here we are.
Well, think about the story that you're just telling right now, too. Like, this completely changes the landscape of how Americans build wealth. So now I don't have to take that body out. I can still grow and appreciate my investment wealth while having less down payment. Now I'm growing my home wealth. And to your point, as home values go up. Now, from an affordability standpoint, is this for the wealthy or is this for everybody?
Well, so they started with crypto.
Mm-hmm.
And then my vision for this, and I haven't called Bill Pulte to ask him, but my vision for this. Anyway, let's not get into that. But what I was thinking is, then it goes to 401k, and that makes it accessible to all. Then it goes to IRA, and that makes it accessible to business people that have self-funded IRAs. So I think this is actually much deeper. And now here's the one. Here's the most controversial thing you'll hear out of my mouth today, and this one should freak you out. It
Bring
would
it.
be savage if this happened.
Bring it.
What if Fannie Mae goes direct to the consumer and doesn't need you?
Yeah, my wheels just jumped 47 steps ahead because, and here's the thing, I'm already seeing the rise of some Silicon Valley disruptors. It's already on the street that could very well be the case. Now throw blockchain into it. Now throw, again, consumer, dollar, the pipe is blockchain.
And you're going to say, how does this happen? Let me tell you how this happens. You take Fannie and Freddie private. You take Fannie and Freddie private, $5 trillion market, dominating the entire housing market of the entire country. And now you've taken the government-backed, mortgage-backed securities off the government's balance sheet. So now they no longer need to be on the government balance sheet. They can continue to subsidize it in some way if they continuously want to in order to create affordable housing and things of that nature. But you privatize Fannie and Freddie. And then now Fannie and Freddie go direct and eliminate wholesale brokers, IMBs, banks, everybody out of the middle. And they just did exactly what you said, Craig. They smashed it together and they went direct to the consumer. You didn't know I was going to say that today.
Oh, that was a good one. That's a good little mic drop. Because I mean, we see what's been happening, even like Figure's been doing, on the blockchain, for example. And I think this is an interesting concept and not controversial, but again, in this barbell where the pipe between borrower and money, and if you have a I picture the old operators, back in like the 20s, and they're just plugging, the dials, directing the calls, right? And there's your blockchain loop. And then as a borrower, I have an avatar that sits on the blockchain, totally anonymized, has all my information. And then there's an intermediary, right? And then they can validate your information in seconds. And then if it's already scoped to the money source, Fannie or wherever that's, now like we have things in the way. We have regulation. We have a lot of fingers in the pie, not just at a mortgage level, but on capital markets and Wall Street and all this other stuff. So there's a lobbyist.
The likelihood of what I just described happening is minimal at best, but I'm describing it because anytime somebody can come up with a concept, then who am I to come up with this concept? But yet I did. And then anytime somebody can come up with a concept, there's a way to monetize. Somebody will chase that concept and find a way, right? Today, perfect day for us to be talking about this with the SpaceX IPO, right? The guy started with the concept
Did
of
you
going to
buy?
Mars.
Did you
No,
buy?
no, I didn't.
I right
I
before we
did miss, I am, shamefully, I'm going to say that I missed the opportunity to buy it about 10 years ago when it was private because I thought the guy that was calling me was trying to scam me. It was like a Wolf of Wall Street phone call that I got one day and they're like, hey, you can invest in SpaceX and it's just a minimum of $50,000. And I was like, this doesn't feel right. And I kind of ignored it and I forgot about it. God, I would probably not be on this podcast today should I have done that.
look at this. Well,
There you
right,
go.
yeah, this backwards, but like 2.25 trillion. That's their market cap as of right this second because of the way IPO is going. But I mean, and we got sidetracked here, but it's
We
again,
did it. It's
but
easy to do with me.
yeah, well, easy to do with me too. But let me pull this back to what you're saying. You just had, that Fannie Freddie, the Fannie example for, and we're talking about blockchain and the consumer and the pipe and all this other stuff. And like, hey, big idea. Lots of complication in the middle, but you know what? Someone will figure it out. Well, take SpaceX and Elon. Hey, I want to put a rocket on and go to Mars. Like, okay, big and complicated. Well, I just did it. Now $2.28 trillion company. Didn't know if that was possible 10 years ago. But what's even the bigger plan there, right? He's trying to own space. He's going to own the entire infrastructure of Wi-Fi, of data, of AI, of interstellar travel, whatever. But like, it's
Bring
just
it.
like,
Let's bring it back down to the ground.
yeah,
Let's
I'm
come
just
out of
saying,
let's
like,
come out of the universe and bring it back down to the ground. So for
these
a
things
loan
are
officer, branch
happening.
manager,
Yeah.
they are happening. And so what I'm saying is those are things you have no control over unless you're the guy that's going to run with my idea. Because I'm not going to run with that idea because I don't have the time and energy to try to do that. I'm not going to lobby and become a lobbyist and get into government affairs and try to get all that to happen. Not my
Yeah,
deal.
I could see you, I mean,
Maybe when I'm older, not now. But that's way far out. So don't be afraid of that.
yeah.
What are the things you can do in your household to affect your quality of life and your next 2 to 5 years? And so I used to say all my business planning, and Craig, you've heard me say this before, is 2 years, 5 years, 10 years. 2 years, 5 years, 10 years. The stuff within 2 years, I have direct control over, and I have a pretty clear picture of what I want to achieve and how I can achieve it. 5 years, the crystal ball just gets a little fuzzy. Maybe it's got a little frost on it, but you're like, I think, I think I know where it's going. And at the end of the 2 year mark, that'll be my new 3 year mark and I'll be able to, that'll become clear. So you have clarity in your first 2 years, a little hazy in the next five, but you should have a target. And then 10 is the dream, right? So the way you back into that business plan is you start with the dream.
Mm,
Where do I want to be in 10? What do I need to achieve in 5 so that I can be there in 10? And what steps do I need to take so that the next two are fruitful and take me to the 5 year mark? And then the hardest part is what can I do today?
exactly.
And then every single day do it consistently as if you already are living that life that you want to live 10 years from now. Because if you don't put out the energy that you're already living that life, you just won't make it. You'll end up staying on the treadmill. You'll be taking steps, but they'll be on the treadmill and you won't be making progress.
And I call it the time traveler. I mean, we are time travelers, and you can collapse that ideal future. You can step into your future and start collapsing that time, going back to your 10, 5, and 2 example. So now aligning my activities today from this conversation. And if I'm an originator, if I'm a branch manager, you're at an inflection point. Which side of the barbell are you going? Are you going to aggregate more business with economies of scale? Or are you going to become a specialist? Or are you going to stay in the middle of the barbell as the barbell is starting to shrink?
Yeah. And I'll kind of, I think we should probably cut it off here with an Elonism that's very appropriate today. It's, so you're telling me it's going to take 10 years to get from here to there. How can we do it in one?
Yeah, exactly.
And if you start with that methodology, then you say, oh my God, but we can't do it in one. But what if we could? What would that look like? If I cut my comp to 20 basis points and my company hired me 22 employees, could I do it? What would it take? What's holding me back from doing it in one? Why do I think I can't do it in one? And if you solve for that and then you miss, you just did it in two
Yeah,
instead of 10.
exactly. And that's why we are time travelers. We can step into our ideal future and collapse time.
Yeah.
Yeah. It's a good
Dude, this was
conversation.
great.
Yeah. This was
Super
fun.
impromptu, totally unplanned, organic, and raw. But those are the things on my mind every day as we build a platform for the modern originator. Not thinking about it collapsing, but thinking about growing into that big side of the barbell and finding a way to have specialists and generalists that are forward thinking and want to grow and scale their business. I'm not on the smaller side of the barbell trying to make most comp per loan. I think that's not where I'm at. That's not where the people I'm looking for are at. We're looking to grow, scale, and have fun doing it.
Well, there's a reason why you joined Lower, and you talk to a lot of people in this industry this time and before. There's a reason why you joined Lower. There's a reason why that's exciting. There's a reason why you are on the side of the barbell of growing, scaling, innovating, investing, right? And
Yeah, working as many hours as I've worked in a very long time, but having fun doing it. And I told you, Craig, I mean, you've seen me go through the whole cycle. We had trauma, right? Trauma and pain, fear, scarcity, all those things coming out of the finance of America collapse. And then now I was like, no, this is time for abundance, growth, energy, excitement, seeing the future, being excited about the future, and leaving the pain behind. And so, like I said, I'm working a lot of hours, but I'm having fun doing it. And having fun in mortgage is a really cool thing. It only happens in certain sub segments of time. And so when you are having fun in mortgage, I think people realize it and they want to have fun in mortgage too.
yeah, you're on fire, brother. All right.
All
Awesome
right.
conversation to be continued.
Yeah. Have a
All
great
right.
day, brother.
Peace out,
Gotcha.
everyone. Hey, thanks for joining me today on Talking Shift. I hope you enjoyed it, and I'm looking forward to seeing you on our next episode.